Okay, I think we're ready to go. So once again, good afternoon, everyone, and thank you for joining us. Um, you will get copy of the slides and a link to the recording within the next couple of days. My name is Sharon Rose, and I'm a SCORE mentor with the Cleveland chapter. Um, what I want to do, and I'm thinking right now for a minute, what I want to do is give you a brief introduction to SCORE and then hand it over to Richard Brooks and Chris Lazar to present Financial Series 2, using financial data to manage our business. Okay, Chris, if you want to move forward. Okay, so SCORE, what is it? SCORE is the largest network of free volunteer small business mentors in the nation. And it doesn't matter what stage your business is in, whether you have an idea, whether you're beginning, whether you're growing, whether you're exiting, we have a mentor for you. Go ahead, Chris. Our mission is to foster vibrant small business communities. And we do that through mentoring, and we do that through education, much like this workshop today. And it's our goal to give every person the support they need to thrive as a small business owner. And go ahead, Chris. We do have had an impact, and we're proud to say that we are a national organization, and together all over the country, we have started over 31,000 businesses, and we've created over 152,000 jobs. Next. And we are there for everyone. We have special small hubs for different types of entrepreneurs. If you're specialized in one area, Black entrepreneurs, vets, Hispanic, women entrepreneurs, we have information for all of you. Go ahead. Because our business is supported by SBA, and some generous sponsors, we are able to provide all of our services at no charge, and we're very excited to do that. So any of the mentoring that you receive, any of the workshops you have attended, you will have no charge for any of that. Go ahead. One of our very important things is that we want to protect your privacy. So we have a code of ethics that every SCORE mentor is required to go through. And the basic highlights to that is that we're not permitted to make any money by mentoring you in any way, that we don't use your information in any commercial way, and everything that you share with us is absolutely confidential. Okay. It's very, very easy to request a SCORE mentor. All you have to do is go to score.org and enter your zip code, and the team who matches requests will work very hard to match a mentor with what you fill out in the form as your interest. You can also take a look at or you can take a picture of that QR code, and that will take you right to score.org to request a mentor. So please don't hesitate to do that. Okay, without further ado, I'm going to turn it over to Richard Brooks, who's going to do the first part of Financial Basics. If you have any questions, please enter them in the chat, and we will get to them after the presentation. Thank you.
Thank you, Sharon, and welcome everybody. Looking forward to working with you. For those of you who attended Financial Basics 1, this session builds on Financial Basics 1 and kind of expands in two areas. Number one, gives you some familiarization, more familiarization with how to use your financial data, your managerial data, kind of tells you how to use that information. And number two, we're going to talk to you about some strategies and tactics once you understand the information that you have in front of you. So we're going to review some of the simplified financial statements to see what insights those statements have for us. We're going to discuss some examples of how financial data can help business owners make decisions. Chris is going to do a lot of that for you. And then we're going to have a discussion on how your business may use the financial data. That's where some of the strategies, additional strategies and tactics come in. Next, Chris. Okay. If you remember, there were three primary financial reports that you would receive for your business. One is cash flow. One is the profit and loss statement or income statement. They're called both. And the third one is your balance sheet. We're not going to talk about the balance sheet today. We're only going to talk about the cash flow and the profit and loss statement. So the first one we're going to talk about here is the cash flow statement. This is a very, very simple version of a cash flow statement. You notice that we start out with a beginning cash balance in January of $5,000 for Puzzle Mania. Puzzle Mania took in $40,312 in January. They spent $21,070 in January. So their cash balance increased from $5,000 to $24,242. And we got that by simply starting with $5,000, adding $40,312, subtracting $21,070, and we end up with a cash balance of $24,242. You notice that for February, we start out with that cash balance of $24,242. We add in $30,938. We subtract out $20,323 as their cost of operations, and they end up with a cash balance of $34,857. You can see this works all the way through the entire year for them. Now, notice what happens toward August and September. All of a sudden, their cash balance drops, and in September, they're only at $243 at the end of the month. That's a major problem. And look where they are in October. $64.57. Again, not a lot of money in the bank. If anything goes wrong, they have no money, and now they're going to have to go out and get some form of a short-term loan to cover them. So you can see why a cash flow statement is so important. It kind of tells you where you are in your finances, and it's a good tool. For example, the reason why they went down in cash between July, where they had a cash balance of $42,349, and August, where they had a cash balance of $15,479, is in both of those months, they were spending a lot more than they were taking in. And this is good information for the manager because, and again, this is based on historical information, it allows the manager to say, well, why did we spend more than we took in? What was going on where we had to spend more than we took in? Now, it happens to be Puzzle Mania produces a product, and it's a seasonal product. Their best sales, you will notice, is November and December. Why? It's Christmas season, and that's when a lot of these kinds of gifts are given. So the reason why they have the cash flow crunch in August and September and October is because they bought a lot of material to create their puzzles so that they could ship them to the stores for the November and December sales. So they ended up with a great deal of expenses in August, September, and October, and they recovered those expenses in November and December, you can see by the end of the year, they're at almost $80,000 in a cash balance. So in that respect, they're very healthy. But what this does is this tells the managers of Puzzlemania, hey, put away money in May, June, July, and August, maybe April as well, so that we have money to buy the products in September, August and September and October to make our puzzles. So that's why the cash flow is so important. Keep in mind that as long as you have a positive cash flow to your company, you have a viable company. If you have a negative cash flow for 6 months, 8 months, a year, you've got a real problem on your hands. And this report allows you to do that analysis. Next, Puzzlemania, the income statement, profit and loss statement. And this one, you'll notice, is a little bit more detailed. And the reason why is it's showing revenue by product. In this case, the 200 piece, the 1,000 piece, the 2,000 piece. And then it's showing the variable expenses. If you remember last week or last time we met, we talked about both variable and fixed expenses. And if for some reason you weren't able to join us for that session, the previous session, it is available by recording. It's out there on YouTube. You can definitely get it, and you can also request from SCORE to get it. Okay, so we have sales, and you notice in this particular case, the profit and loss statement you can do for a month, a quarter, for the entire year, just like we saw with the cash flow statement. But in this case, we're doing comparing 3 years, 2020, 21, and 22. And there's a reason for it, and I'll explain it in a couple minutes. So you notice that in 2020, they did $360,000 worth of revenue, and it's divided up between the 3 products that they sell. The 112,500 for the 200 piece, and that's 31% of sales. The 1,000 piece, 127,500. And that's 35% of sales, and the 2,000 piece, 120,000, 33% of sales. And you notice across all 3 years, the percentage of sales by product has pretty much remained the same. And then the variable expenses you can see below, and these are direct expenses to producing those 3 products. So for example, the 200 piece, that includes the raw materials and the direct labor and the packaging for the 200 piece puzzle. The same thing for the 1,000 piece, and the same thing for the 2,000 piece. And you see that their percentage of sales is pretty much the same. Their cost is pretty much the same for all 3 years. So their total variable costs are totaled below it, and then it shows the gross margin. The gross margin is the total revenue minus the total variable expenses, and again, we discussed some of that in our last session, and then our fixed expenses. And you notice the fixed expenses are pretty much the same as well. The only time fixed expenses would change is, for example, they may have done a lot more marketing, and marketing is considered a fixed expense. And their profitability remains at about 21%, which is really good. So how does this data differ from cash flow? Well, the first thing is it's a lot more detailed. And in the case of cash flow, what you want to know is whether you took in more money than you spent, or you spent more money than you took in. That's different. Having money in the bank is different than your profit. You may actually have a situation where on paper you make a profit, but in fact, you had a negative cash flow. And that doesn't sound like it makes sense, but in fact, it can happen. And there are reasons for that. We're not going to go into a great deal of detail today, but there are often expenses that a business will have that do not involve direct cash. And for a clearer explanation of that, and we really don't have time today, best to ask your accountant or your SCORE volunteer, and we can explain everything to you. So another question, did the company make a profit in the first year? Well, sure. It made 21% profit of $74,760 on, that's 21% on $360,000. What product brought in the most revenue in the first year? Well, the most revenue was brought in by the 1,000-piece puzzle. And then what product was the most profitable? Well, it really depends on how you're looking at it, but the most profitable is as you can see floating down there, is also the 1,000-piece puzzle. Okay, next. Okay, let's look at Lulu's. Lulu also starts out with $5,000 in January. She brings in $55,000 during the month. Her expenses are $40,682, and her ending cash balance is $19,318. And you can see what happens now during the year. Lulu's cash balance continues to grow over that time. And by the end of the year, Lulu is at $129,546. Again, keep in mind that this is a very simplified example. Okay, most cash flow statements would somewhat break down where the cash was coming from for the cash in, and then for the cash out, it would show expenses and in more detail. But for our example, this is all we need. So it's $129,546. So a couple of things that Lulu should ask herself. First of all, does she have any significant seasonal variation? And if we look at the cash in, while it does vary from month to month, it really is not a significant change versus what we saw with Puzzle Mania, where after January through July, or pardon me, through September, their revenue was really down. But in November, December, and January, that's when their really strongest season was. And then in this case, cash out, if you were to see percentages next to this, you would see that her cash out is relatively proportionate to what she's making. So that then leads to the next question. Does Lulu really need the huge cash reserve of $129,000? And considering what she's spending on average of around $45,000 a month, that $129,000 is really not needed. And so there are a number of things Lulu could consider as far as strategies to absorb that $129,000. She could do some investments for her business. She could spend some money upgrading her facility to make it nicer. She could offer bonuses to her staff. There are all kinds of things that she could do. She could just take the money and run as well, but we don't recommend that. Okay, next slide. Okay, here's the profit and loss statement for Lulu's. And you notice that we've broken it down into three sources of revenue. And again, these are services. So she does shampooing, she does hair coloring, and other services. And again, we compared 3 years. You could do month to month, quarter to quarter, and in this case, we're doing year over year. So you can see that year over year, her sales, even though they've increased between 20 and 2022, the percentage of sales between shampoo, color, and other pretty much remains the same. Okay. And you have 18% for shampoo, 48% for coloring, and 34% for other services. And then for the variable expenses, again, they are remaining fairly flat as a percentage of sales. We want to keep this as simple an example as possible. In 2020, her variable expenses, total variable expenses, were a little bit over $401,000. In 2021, $441,000, and in 2022, $485,000. Her gross margin remained at about 60%, and her fixed expenses, again, remained flat at about 21% of sales. So her profit in 2020 was $125,000. In 2021 was $137,600, and in 2022 was $151,369, or 19% of sales. But I want to point something out to you, okay? If you look at Lulu's revenue, okay, let's look at shampoo for a minute. In 2020, she did $120,000, and in 2022, she did $145,200. Well, that is a 22.5% increase in sales for shampooing. For color, she did $318,800 in 2020. By 2022, she had done $385,748. That's an increase of 21% in sales. Let's look at other for a minute. In 2020, she did $230,000. In 2022, she did $278,300. That is only an increase of 9.8%. So she did 22.5% for shampooing, increased sales. Her color was 21%, but only 9.8% for other. This is important information for her. And this is where the managerial accounting comes in, because she needs to look at this and say, well, my other products have grown significantly, over 20% each. Why has my other services only grown 9.8%? Is it price resistance? Do I need to add additional services or products on in the other category to grow that sales? And so she needs to look at this, especially when if her expenses under variable expenses have grown. Let's say her nail polish, the cost of nail polishing, the actual polish itself, has grown by 20%, but she's only taken in 9.8% additional revenue. That's a problem for her. And that's why this report is so important, because you can look at this and actually do an analysis, okay, of what is going on financially within the business. So she ends up with good profit at the end, but she might have been able to actually grow her profit beyond the 19% if she hadn't had that problem with the 9.8% increase in sales in the other. Okay, so that's a good example of what do the percentages tell you. I'm not going to go into the rest of the questions on this slide, but you can kind of see where it all fits in. Chris? Okay, this is where Chris takes over.
So thank you, Richard. We are going to now talk about some different scenarios in the real world that your business might be looking at in terms of investments or coupons, and how do they affect the bottom line of what you're doing. So we are going to basically go through a couple examples of both the Lulus, and we're going to see how do decisions affect your bottom line. So one thing we're going to cover is Lulu's been doing well for 6 years, and she's now considering opening a second location. And we're going to look at her numbers to help us decide, is this a good idea? Should she open a second location? How is that going to affect her work-life balance, her bottom line, and profitability? So if you were here for our last, the first session of this series, you saw that Lulu has very, very healthy profitability in her existing shop that she has. So she does roughly 18 clients a day, 6 days a week. She brings in roughly $55,000 a month. And between her fixed and variable expenses, her profit is almost $11,000. If we divide 10,871 into her sales of 55,728, we see that she has a profit margin of 20%. So you might be looking at this and thinking, well, if she opened a similar salon in another location, would it be reasonable to expect that she could bring in another roughly $10,000 of profit from another location? That would be the goal. Double my locations, double my profits. But there's one thing that we really did not account for, and that most owners don't account for, which is their time. So we have her fixed expenses of $11,420, and her variable expenses is 60%. So her overhead is just under $45,000 a month. But Lulu doesn't pay herself as an employee. Lulu just lives off of the profit of the business. If it's a really good month, she takes home more money. If it's a slimmer month, she takes home less money. This is very common for business owners. So we're going to now look at, well, how does this change? Lulu's only one person. She works roughly 55 hours a week in her business. Now, when I say 55 hours, some of it is from home. She can do some social media marketing from home on the weekend. She's not necessarily at the shop for 55 hours, but she puts in a lot of time both in the salon and out of the salon. So if we thought about opening a second location and we can't have another Lulu, we'd have to hire someone to work basically as a manager of her second location and do things that are similar to what she's doing for the first. So her time is valued, give or take, at roughly $35 an hour if she'd have to find a manager for that second location. So if she paid someone $35 an hour times 55 hours a week, and we multiply that by 4.3, because there's 4.3 weeks in a month, her overhead for the manager alone is $8,278. So that's adding another 15% to her expenses just by hiring a manager. So all of a sudden, she has jumped her expenses from $44,857 to $53,135 for the month. It leaves her a profit margin of $25.93. That's 5% of her sales. So again, we have to think, well, there's a lot more liability. There's a lot more employees to manage. There's more insurances, and all of that is factored into her expenses. But when we think about the time, energy, and stress, even with having a manager, At the end of the day, it's still her business. At the end of the day, if the manager is sick or whatever's going on, it's her responsibility. So, is that added responsibility worth $2,593? So I don't know I don't want to jump too far ahead of this. If you have any questions about this, put them into the chat. And I think it's important when you're looking at your own circumstances and situations to, if you haven't considered what it would cost to replace you in your business, to still see what the profitability would look like. This is, again, where working with a mentor, we can go through and help you evaluate your time, the value of your time, what's left over, and if an opportunity like this would be a good move or not. Okay, we're now going to talk about using coupons. I think we've come to a world where most things are on sale at least some part of the calendar year. And one of the things that happens, I think, is that some customers, if they plan well, they will come to rely on and wait for coupons to do their purchasing. So once you start offering coupons, you might find that your clients are waiting for these things to repurchase or to engage. So what is important is to understand, how do coupons impact your bottom line? And then when is it a good time to use it, and when maybe is not a good time to use a coupon? So we're going to just stick with Lulu as an example. She sells hair products, and it's very common that the markup is what is referred to as keystone markup. And it basically means the wholesale cost is generally doubled to get the retail cost. So most of the time, if you see any products that say suggested retail pricing, it's not 100%, but most of the time, the wholesale cost of that item will be half of what you see as the suggested retail cost. So just to keep it really easy for numbers so we can see the impact, one bottle of, let's say, shampoo will cost Lulu $10, and with standard Keystone markup, she'll sell that $10 bottle of shampoo for $20. So double the wholesale cost. A $20 bottle minus her $10 cost of the bottle gives her a gross profit of $10. If she sells 100 bottles at $20 each, she's going to bring in $2,000 of sales. If she multiplies the 100 bottles times her $10 profit per bottle, she's going to have $1,000 gross profit. So her sales will be $2,000. Her gross profit will be half of that, $1,000. So she's got a 50% gross profit margin. Again, this is just standard, no coupons, regular business. But all of a sudden, how does this look if she is going to offer just 20% off? Now, the thing to keep in mind is she's offering 20% off, but that's applied to the retail amount. So it really takes the profit down considerably. So let's see how this works out. She's got a $20 bottle minus 20%, which is $4. That's going to make her bottle of shampoo with the coupon $16. Her cost of that bottle did not change. The cost of the bottle is still $10. So we are going to subtract. She has a sales price started of $20 minus $10 for the cost of the wholesale bottle of shampoo minus the coupon of $4, and her profit margin dipped down considerably from $10 down to $6 gross per bottle that she's selling. If she now sells 100 bottles, the same as last time, Her now sales price is $16 a bottle because she's got the $4 discount in there. So her sales are now $1,600. Her profit is only $6 a bottle times 100 is $600 of profit. And if we divide $600 into $1,600 of sales, her gross profit margin just from that little $20 coupon jumped down to 37.5%, where it was 50% before. So there are times to think about, you may want to just have more sales and more not, but what does she have to do if she wants to go back to making that $1,000 of profit? So the first scenario with no coupon, she sold 100 bottles to make $1,000. Then she sold 100 bottles to make $600, but we want that $1,000 profit. We don't want to lose profit just because we have a coupon. So if we divide the $1,000 of profit, that was her goal, and we divide that now by $6 of profit per bottle, all of a sudden she has to sell 167 bottles to make the same money that she was making before she had a coupon. Now, again, back to what Richard was saying about cash flow and investing more money, expecting more sales, one of the things to consider is she has to invest, she has to have money available to now stock 67% more. She has to carry and purchase and hold a lot more bottles of shampoo, which is more investment of more of her money to get out the profit that she's looking for. So again, this is something that if you're doing this kind of thing, looking at how this affects your cash flow is an important part of this as well. So again, I'm jumping to the next thing. The bottom line is there are times that you want to offer a coupon, and there are times where you may not want to offer a coupon. So some of the times where you would want to offer a coupon is maybe you have a tremendous amount of foot traffic and you want to capitalize on that foot traffic, and it's more about, that you're heading into the holiday season, your cash flow is going to be very strong, so you can afford to put more money in inventory to sell this. Another opportunity is sometimes manufacturers and distributors have sales, and you might be able to get a 20% off price from the vendor that you're buying the shampoo from. And in that case, you would still have to sell a lot more bottles, but your cost in would be lower, which would make your gross profit margin healthier, and you would just basically pass through that discount. Another time that you might want to do this is you might have some inventory that's getting kind of old or stale. I know shampoo can last quite a while, but you don't want shampoo sitting on your shelves for years. So after a certain amount of time, if you made a big purchase of something and you're not seeing it turn quickly enough and you feel like it's collecting dust and getting kind of old, that might be a nice time. Another situation is going back again to cash flow. You might have a lot of inventory and that you're heading into some lean months cash flow wise. Maybe it's the opposite. You're a seasonal business and you're in your dry time. It might be a nice time to generate income quickly by putting stuff on sale, and your profit margin is lower, but that's okay, because right now the more important thing is getting cash into your business, and you can wait for another strong period and then do more purchasing. So that is how a little $20 coupon can have a dramatic impact on your bottom line. We're now going to look at how to know if advertising is worth the money that you've spent. So one of the ways that this is calculated, you may have heard of ROI. That is your return on your investment. So your ROI is just a calculation that you can figure out. What you need to know to calculate your ROI is you need to know what your profit margin is and what the revenue is that you generated from a particular advertisement. So as an example, when you're doing advertisements, and this is important for all of your marketing efforts, it's important to know where revenue is coming from specifically so that you can see, is this worth redoing again? So let's say you do, well, we're doing puzzles, but if you have a business that is seasonal, and you're doing something, you're advertising on Instagram, you're advertising on Facebook, and you have a local ad that comes out in a direct mail to people in your community, put different codes to be associated with the different places that you're advertising, because when people use those codes, you'll know exactly where they came to you from, versus you advertise in a variety of places, you have one just coupon code or something that people bring in, and you don't know exactly where you're getting those leads from. So we're going to look at Puzzle Mania. We, again, going back to the first session, they have roughly 30,000 in revenue each month. And we calculated their profit margin is approximately 21%. So they have an opportunity to put an ad in a paper that costs $2,200. This ad brought in $14,000 of new sales. So you might look at this and say, wow, $14,000 is so great compared to just a cost of $2,200. But what did the actual ad leave in the profit of the business? It's not just about what you sold from it, it's what money is actually left in your pocket at the end of the day. So to calculate this, we're going to multiply the 14,000 of new sales, and we're going to say times 0.21. That's going to give us 21% of those new sales generated from that advertisement. So that comes out to $2,940. That's $14,000 of sales at a 21% profit margin. So we're going to now take that profit, 21%, $2,940, and we're going to subtract the cost of that ad, which was $2,200. So $2,940 minus $2,200 leaves us a profit of $740. Now we have to think of the time it takes to create this ad, the money invested in the ad, the money invested in all these puzzles. That's a lot of inventory and a lot of money invested to sell $14,000 of puzzles. And what's left in your pocket is $740. If we divide 740 into the $14,000 of sales, that shows us that we have a 5% profit margin on that batch of puzzles that were sold with that advertisement. And then to have an idea of the puzzles, we know the puzzles cost $20. So if we divide 14,000 by $20 per puzzle, we know we have to sell 700 puzzles out of our inventory to make that $740. So now we're going to look at our ROI. What is our return on our investment? So the calculation for this is to take the gains, which was $2,940. We subtract the cost, which was the cost of the ad, and we divide by that same cost of the ad. So if we subtract $2,940 minus $2,200 divided by 2,200, that shows us a 34% ROI or return on our investment. $740 was the increase in profit for placing this ad. So you can look at this and say, all right, this is how this ad worked out. When this opportunity comes around again, do I want to put in another ad for $2,200? Is it worth it? When you have an idea of what you've gotten out of an ad, you can go back to that publisher or online or wherever it is. There are some places where you can negotiate the cost of ads, and you can say to them, this was my return on my investment. It's not worth $2,200 to me, but I would do it for $1,500. But now you have data, you have information. You can see, how did this work out, and do I want to do this again in the future? If you don't keep track of this, then you don't really know, should I do the ad or not? You're kind of shooting in the dark at that point because there's no data to back up that decision. We're going to look at the same situation, but there's a very minor difference in this slide than the one before. Now our ad is $2,500. So we went from an ad that was $2,200 to an ad that's $2,500. So if we do the exact same thing, we know that our cost of $14,000 in sales brought in 21% profit margin. It's the same. $2,940 is our profit before our ad expense. If we subtract $2,500 from $2,940, we're left with $440. So again, we had to sell the same 700 puzzles, and $440 divided by 14,000 of sales leaves us with a 3% profit margin. So again, if we want to calculate our ROI, our return on our investment, we take $2,940 minus $2,500 divided by $2,500 shows us we have an ROI of 18%. So you might look at this and say, well, absolutely no way would I ever do this for 3%, but there are things to consider. If you have puzzles that have any kind of time sensitivity, therefore something going on that year and no one's going to want them after that year, you're going to at least want to burn through your inventory and recoup whatever investment you've made into that inventory. So better, instead of setting on dead inventory, even if the was break even, I would want to get my investment out of sitting on inventory that's not going to sell after a certain period of time. Another time this might be a good idea is you have a completely new product that you love and you believe in, and you think that your clients and customers are going to love it. You might decide, I really don't care right now about the initial profit margin that I'm going to have. My concern right now is I want people to try and know about this product, a new shampoo, a new something, a new design, a new anything. And then you think, even if I sell it for very little profit, I will hopefully be able to have repeat business out of that and get people to try something new that they maybe wouldn't try without spending money on that advertisement. So that is, I think, the end of this. We are going to go back to Richard. He has some other ways to think about and work on your profitability.
Okay, thank you, Chris. We want to get into some additional strategies for you right now that you may be able to use on a day-to-day basis. The first one you notice says fire your worst customers. We're really not talking about firing customers. That's but we wanted to just kind of get your attention on this. You have customers who expect the same discounts as your largest customers. These are your smaller customers. But they just don't buy a lot from you, but they know that you're giving a 5% discount or a 10% discount to your volume customers, and they want the same thing. or you have customers who pay their bills in 60 to 90 days instead of your usual terms, which is usually payable on receipt. You have customers who dispute some of the charges, that you have on your invoice, and then you also have customers who return a large portion of the products they buy from you. They may be returning them because they didn't sell it, or other issues. They overbought, whatever it happens to be. You don't want to give these types of customers your best deals. You want to give them the deal that works best for you. My background is hospitality. I worked in hotels and restaurants for years and years. And let me give you an example of how hotels do discounts. Somebody would come in representing a company and say, if you give us a 10% discount on guest rooms, or if you give us a discount, let's negotiate the number out, what the percentage will be. We will give you 250 room nights. In other words, one person in one room for one night. We'll give you 250 room nights for the next quarter. And you do your little calculation and say, that's 250 guest rooms that I can sell that I wouldn't have sold before. And so I will offer a 10% discount. And that's how they work it. The same thing goes with group charges. A group comes in and says, we want to have 100 people attend a group for 3 nights. And you look at the numbers and say, okay, that's 300 room nights. And because that's good business, it's a foundation business for my hotel, I'm going to go ahead and offer a 10 or 15% discount on guest rooms so that I can get these 300 rooms set up. But then what hotels do is they track it to make sure that the customer is doing what they say they're going to do. And so in the case of the company that comes in and says, we'll give you 250 room nights if you give us a discount, you track it. And if they don't hit the 250, let's say they only do 150, you don't extend the discount for another quarter. It's not worthwhile to you because you've offered a discount and you have other guests who can pay higher prices for those rooms. So that's an example. Same thing with the group. If they want 300, 100 rooms for 3 nights, and they only do 70 rooms for 3 nights, that's 210 rooms, not 300. When they come back the next time, you say, we really appreciate your business, but you didn't pick up what you did last time, and what you committed to, and so we're not going to extend the discount to you for this time around. Okay. So you have other reasons. Now, the second bullet point I also want to dwell on for just a moment here. You have customers who pay their bills in 60 to 90 days. If you'll remember, one of the things that we said in our last session was if somebody takes 60 to 90 days to pay you, there's a cost of money to you to do that. In effect, your customer is using you as a credit card. Don't do it. You need to be kind of aggressive. If they can pay by credit card, that's great. If they pay by cash, that's great. A number of businesses that I was involved in, our motto was, in God we trust, all others pay cash. So think about that. Don't allow customers to go beyond 30 days. And much better, everything is payable upon receipt of the service or the receipt of the product. It's very important that you do that because you don't want to be somebody else's credit card. It costs you money. Next, Chris. Do you have customers you would fire and why? Just consider that question and think about how you would handle it. Okay. Okay, expand your products and services. Build a defendable fort first. Test your ideas with customers, minimize your investment until you know you have a market for your product or your service. Do a competitive survey, think outside the box, but be cautious. I want to go back on this. Build a defendable fort. For about 11 years, I worked for Nestle, and their philosophy in bringing out new products or bringing out additional products in an existing product line is to build a defendable fort. And what they mean by this is start out slow, make sure that what you're doing has a market, test the market, and then grow from there. And let me give you the best example I can on this. You're all familiar with a product that Nestle has, Lean Cuisine. Lean Cuisine was brought out in the mid-1970s. And after Stouffer, which created the product, developed it, they tested it in a couple markets first. And then they grew first by going nationwide or regionally, and then nationwide with just a small number of products. I think there were like 8 to 10 products that they actually started out with. And then they added on products 1, 2, 3 at a time until they had a full product line available. Well, by the time their competition, ConAgra and some of the others, saw what was going on, they had built a defendable fort, and the competitors were not able to take away significant market share. To this day, Lean Cuisine has 50% of the health-conscious food market in their market segment, the frozen market segment. So Nestle built a defendable fort using this approach, and the competitors were able to siphon off some of it, but they were never able to really establish market dominance over Nestle. So that's an idea. Test your idea with your customers, and it's do more than just say to the customers, do you think this is a good idea? Because most customers will say, oh, yeah, that's a great idea. But that really doesn't tell you whether they will buy your product or your service. So you need to go out more directly. Maybe one way to do it is to buy a very limited amount of a product that you want to resell and let your good customers know about that product. A lot of you are already accumulating email addresses, or they're on your Instagram page or whatever, and you really sell only to them and see how it goes from there. That's a good way to test your product or your service. And then if it goes very well, then you can go ahead and expand because you know that you have a market base for it. Minimize your investment so you know you have a market. Same thing. Buy a limited amount of product or only offer the service to a limited number of people until that you know what you have, because you don't want to go out and spend a lot of money on something that you're really not sure is going to sell. Do a competitive survey. Find out what your competitors are doing. Do they offer the same product or service as you do? Or, do they offer a lower cost one or maybe a more premium product? And we talked about that in the last session, offering a premium product and being able to upsell. And then think outside the box, but be cautious. I'll give you an example. You own a store that sells ladies' dresses. And you've been doing only dresses up until this time. And now you've got the idea that maybe you want to do overcoats, winter coats for the ladies, or you want to add a shoe line or something like that. That for you could very well be outside the box. Be cautious. It could bring in additional business, but it could also confuse customers on exactly what you're offering, especially if you kind of hide things in the corner and you don't really let customers know what you're doing. So think outside the box, but be cautious. Next. Okay. You need to think about what is thinking outside the box and how that would impact your business. Okay. Okay, let's skip this one. Okay. Reduce your fixed costs. Renegotiate your lease. A lot of leases are negotiable, especially when it comes time to redo them. It's the end of the lease. You would like to stay with in your location, but you go to your landlord and try to renegotiate the lease to control your costs better. Most leases are triple net leases in the sense of you're paying the taxes on the building, you're paying your maintenance, you're paying for your garbage hauling, you're paying for basically everything in addition to the actual physical lease on the building. Maybe you can get the landlord to add a service that you're currently paying for. Okay, maybe they're willing to pick up water, or they're willing to pick up the refuse collection. So there are different things that you could negotiate for. Be sure you are taking all the tax credits you are entitled to, especially if you have a home business. This is an area where your accountant can really help you, because a lot of home businesses, the owners of those businesses are not taking tax credits that are available to them. For example, if you have rent on your home, you're paying rent, on an apartment, or you're paying your mortgage. There are legitimate ways of determining how much space your business is taking in your apartment or your home, and actually applying a tax credit to it. You do need your accountant to do that because there are some strict rules available about taking tax credits for home businesses. But it's important that you do that. Same thing applies to your transportation costs. Same thing applies to cellular wireless telephones. Look at that very closely. You'll have to do some tracking, but it certainly makes sense to take the tax credits. Consider lower cost suppliers if you can do that. But sometimes they may be more costly in the long run. A good example of that is a restaurant that buys a lot of fruits and vegetables every week. Most good restaurateurs will have 2 or 3 fruits and vegetable suppliers, and they will check the prices with each one each week. And maybe they buy a case of lettuce, and 3 days later they buy another case of lettuce. But they want to be careful on that, because the low-cost supplier, there may be more waste with that case of lettuce. So they have to be careful. And then finally, consider bundling. We've seen a lot of TV ads for bundling your home and your and your car and your motorcycle and your boat and your RV and all this kind of stuff. Bundling will often earn you a lot of discounts. But again, watch what you're doing on that to make sure that your business's liability insurance and your business interruption insurance and your fire insurance, if you can bundle that all together, maybe add your vehicles on, your theft, that could earn you some significant discounts with the same supplier. Go ahead, Chris.
Just want to mention we're at 1:05,
Yep.
so I think we have used up our time allotment and then some a little bit. So yeah, thank you everyone for joining us. It looks like we've lost a few people at the end. If anyone wants to stay on, Richard and Sharon, are you okay for a couple minutes if people have questions?
Sure.
I am.
And
Yeah.
I am, just before everyone gets off, I a lot of people had asked for the information for your first financial series. So I am putting the link to that in the chat right now. And then there was a question, Richard and Chris. Okay, the question that someone added was, should owners pay themselves with a paycheck instead of just taking from overall income? Can either of you answer that?
Do you want to go? You want me to go?
No, I can take that initially. It really depends on your financial situation. Okay. Number one, it depends on whether you're incorporated as an LLC or as a S corp, or if you're not incorporated at all, you're just a sole proprietor. There are several issues on that because they affect the way you pay your taxes. Number two, it also affects the way your company profitability, in the sense of, if you pay yourself only based on the success of your company. In other words, you take a draw instead of a salary, or you take a salary instead of a draw, or you take a bonus and instead of either one of those. It affects the way your personal taxes are reported. So it's important that you discuss this with your accountant. What SCORE generally recommends is that one way or another, whether you take it as a draw or you take it as a salary, you make sure that you include it in your overall financial projections to make sure that you have money there, because what you don't want to end up doing is not putting it in your financial projections, figuring, well, I'll just do it on a draw base, because I know it'll be successful. And 3 months later, you find there's no money in the bank to take the draw on because all the money's gone into the business. So it's just something that you have to be careful of. And your financial advisor, your accountant, will be the best resource on that. Chris?
No, I think you hit it perfectly. The real incentives around being a corporation versus an LLC have to do with the tax benefits associated with having employees, and even yourself as an employee, for putting away money pre-tax in health vehicles like a cafeteria plan, putting money away for retirement, all sorts of things. So it is really good to work with an accountant. Certainly a SCORE mentor can get you started with some of the basics, but for your actual circumstances, your accountant will have the best information. But ideally, you definitely would want to work. It should be a goal to work to a place where you have steady and regular income that you can rely on. And then if there's extra, those come through in bonuses or other ways. But you know that you have a good foundation that is modest and sustainable. So that would be a goal to work towards.
Sharon?
Great, thank you. There was one other question in the Q&A. Someone had said, I'm a new independent artist, LLC. I have not sold any art yet. Is it okay to purchase supplies for making the art with my own money until I make an income and ability to use business money to purchase supplies?
Chris, go ahead on this one.
Okay, so yes, 100%, every single thing that you purchase is going to be a loss, and you cannot take the loss now, but you can carry forward your loss until you start to make money and have profits. So there's a couple ways to do it. I definitely recommend, even if you have no revenue at all, set up a separate bank account and set up a separate credit card or way of purchasing that should be completely separated from your personal situation. So when you make purchases for canvases, for paints, for whatever it is, have that come through a separate credit card and show up on a separate bank statement, and you can carry that forward for years. One of the things that you can do is put in a loan from yourself to your business, and let's say fund it for $300 to start out to do some of those purchases, instead of keeping track on your personal account and then having to transfer that over to your business. So whatever you can afford, set up a separate account, put a chunk of money in that account to be used just for your business. And then, like I said, even if you sell your first sales in a year or 2 or 3, whatever profits that are had out of that, you can use the investment that you've made to first start paying yourself back, and then you can actualize profits after that.
And that's, Chris described that very well. The term that is used for this is amortization. And you'll hear your accountant use that term. It's a big, long word, but what it really means is it allows you to recover your many, not all, but many of your startup costs. And in the case of an artist, whatever your art supplies are, you can amortize over a certain period of time. Again, the government has some very strict regulations on that. Your accountant knows or has access to that information and can help you determine what the best approach is.
Great. Everybody, let me see. You had a lot of wonderful comments here. Someone who just asked for a link to the last presentation. It is in the webinar chat up above, but I will do the same thing. Someone says, I have a craft business and was considering doing the same thing. So it looks wonderful. I don't see any further questions. I will add the link one more time right here. And I give you a minute to capture that link. And if there are no other questions, I think you guys did a fabulous job today, as is evidenced by the chat. And thank you everyone for joining us. And we will send you the link and to the presentation, as well as the slides in the next few days.
Thank you.
Okay, thank
Bye.
you.
Everybody have a great week.
Okay, bye-bye.
What, okay?
Yeah, I'm gonna do the link. People are saying they're not
Yeah.
seeing the link.
Yeah. Okay, I'm off.
Go ahead, I'll stay on for a second so people can pick. Great job.